This is the fifth and final part of the master budget. We're going to be preparing an income statement and a balance sheet. A lot of the data that we have already been processing in the prior budgets are going to be summarized here, but instead of a month-to-month summary, we're looking at overall quarters. So let's just start with the income statement. Our sales revenue, of course, will go all the way back to the sales budget, and we will pick up the quarter amount. The cost of goods sold, well, it will stem from right here. We just did on the cost of goods sold budget. And then the gross profit is just the difference between those. And we saw that relationship a little bit ago as well. Now, as far as these operating expenses go, some of these we've already dealt with already. Now, recall, these are operating expenses. These are those period costs. The product cost has already been tracked in the cost of goods sold. So I want to go back to the cash disbursements for these costs and make sure that we get them on here. So let's go back and get the administrative salaries. That's $42,960. We need the advertising. That's $48,000. And then I see I've got utilities and rent, so let's get those while we're into it. I know I'm skipping some in the middle, but we'll come back to them. And then, of course, rent. Now that only leaves me with these two right here. The administrative depreciation expense is going to be found on the first page of our data sheet, and it's down at the bottom of the page, and it says the administrative depreciation is $4,000 a month, and so that would mean that over the quarter we have $12,000. And so all of the expenses so far are pretty straightforward to get. The bad debt expense here now, this is the one that is going to be the most challenging for us. Bad debts expense represents those people who said would pay me later on credit but never do. In other words, they're deadbeats. And this is always an estimated amount because I don't know how many people aren't going to pay me. I can't cherry pick and say, oh, this customer's bad, this one's bad. Hopefully I would have had credit policies in place to prevent it from happening, but there is no guarantee that letting someone pay you on credit that the person will individually pay up. There are things that could happen that could cause the bad debt to occur. This bad debt is accounted for through what we call an allowance for doubtful accounts. These represent the customers, again, that are not expected to pay. And this company's expectation is 1% of the receivable account will be uncollectible. 1% of the receivable. Alright, so I'm going to put my accounts receivable here. And if you recall, we've already calculated that. When we were dealing with our cash collections, we went ahead and determined that the amount as of the end of March would be $159,600. That's what we are expecting to get in April. And now we're estimating that 1% is not going to be collectible. So let's take 1% of that. So in other words, 1,596 is expected not to be collectible. Let's see how much already exists. So in the allowance account itself, we already have 1,575. Obviously, that's not enough. We need $1,596. The difference between those two values is $21. And that is what our bad debt expense is. The amount that we need to increase the allowance for people we think won't pay, given our estimate, is $21 more. When I add all these costs, I have my operating expenses. The operating income is the difference between the gross profit and those expenses. I'm down to $13,000. We have a couple other items here. Discount on purchases. Now, let's go back to that cash disbursements for purchases budget, because that's where we calculated those discounts. And it was $4,937, which is what agrees on your page. And these actually represent savings. In other words, you didn't have to pay that money, so it should reduce your costs that we've incurred. And remember, this is all budgets. And so we factored in this cost of goods sold how much you're paying for your purchases. Well, if you're saving this much, your cost of goods sold really should be updated to reflect that, and that's what this does. It compensates for that. The interest expense overhand, remember, we calculated that when we were doing the cash budget. So let's go back and pick that number up. Recall when we did this, we looked at how much you still owed on the principal, and we found the interest. And when we compare that to what we've paid already, together, there's the total interest cost for the period. Some is paid in cash, some is yet to be paid, but the total is $220. And that $220 is what, of course, goes down here. Now, I know on my screen here I've got recovery on bad debts. This is an account that you're not going to be using, so if it isn't on your handout, that's great. It just so happens I have it on mine, so we'll just ignore that. So I'm going to combine all of those three figures, and that says your income before taxes is $17,859. To get the taxes, we will go one more time back to the data sheet, and this is on the second page. And it's right before the required. It says your tax rate is 40%. So I will simply say 40% of your income. Now if you notice, when I calculated it this time, it showed up with some cents. I've been keeping all those decimals pushed to the side just to make the numbers a little bit easier, just to visualize. But note that there can be some pennies behind the scene here. So just because you don't see it doesn't mean these are all nice and even numbers. Now when you subtract your taxes, it leaves you your net income. So let's really assess if this was a good year for this company. I'm going to go back and do some financial ratios. The first one I'm going to calculate is called a gross profit ratio. Remember that one? Where we were trying to convert the sales to costs when we were calculating our ending work in process. And we said this company was expecting a 40% gross profit rate. Well, let's see if that holds true. I'm going to take that gross profit and I'm going to divide that by the sales revenue. And this company is only earning, if I put this into a percentage form, well, about 14.5%. A far cry from 40% expectation. What does this mean? Well, it basically means that the costs are higher than what we're expecting, and we really need to do something about it. And this is a benefit of preparing these budgets in advance, because you can see these results, and if they don't pan out, then you need to go back and do something before you actually commit to these plans. Now let's go down a little bit further. Let's see the bottom line, your overall return. I'll take that $10,000 and I'm going to divide it by, again, the sales revenue. And this bottom line says that this company earned about 1.25%. For every dollar it sold, once we've considered every single expense, you have $1.25 left over. That is not a good return. Most companies desire a 10% or better, and this is not even achieving it. This company could have actually done better in some cases just putting the money into the bank, into a long-term, maybe a certificate of deposit, a CD, and earned 2%. So you could have done nothing and done a little bit better. So in this case, what we need to do is try and figure out what is happening and correct it. The balance sheet is going to be summary as well, and most of this we've already calculated. The cash, well, we're going to get that from our cash budget. So if I scroll back to the cash budget, we can look at the quarter, and there's the total amount, $8,437, and that should agree with what's on your handout. The accounts receivable, if you remember, we already calculated that when we were doing the cash collections up here. So I'm going to go back and reference that one more time. The allowance for doubtful accounts, we just calculated right here. We need $1,596. And so really, our best expectation, once we take out that provision for people we think won't pay, we really think we're only going to get $158,000 of our receivables, the net. That's not too bad. All these inventory items we calculated already. The materials inventory, we did that back on the cost of goods manufactured. There it is right there. The ending work in process is also on that cost of goods manufactured. It's right down there. And lastly, the finished goods inventory, that came from the cost of goods sold budget. And so there's the $81,000 figure. I can add those three, and I get my total inventory. And then I can combine the cash, the receivables, and inventory and get something called current assets. And recall, current assets reflects those assets that will have a cash impact essentially within a year. When we get to the property, plant, and equipment and the accumulated depreciation thereof, we do need to make some changes. Let's see what we started with. If I go back to my problem sheet, we started with $175,000 and $25,000 respectively on the equipment and depreciation. But don't forget, during this period, we went out and bought $30,000 more of equipment. So when I put those two together, I have $175,000 that I started with, plus the $30,000 I bought, and that gave me the $205. As far as the accumulated depreciation, we started with the $25. And then I know we've added more to it. We had $12,000 of administrative depreciation, and we had $30,000 of plant depreciation. Now the $12,000 and the $30,000, of course, we'd already incorporated back into the budget, and you could go back and reference them as well. But for the sake of time and simplicity, I'm just going to type the values. And then, of course, when you take that away from what you have bought, that gives you what's called your book value. So we have $138,000 left on the assets for property, plant, and equipment. The other asset, it was listed as $10,000, and we didn't do anything else with other assets this period, so it's still $10,000. When I combine the current, the property, plant, and equipment, and the other assets, it says our total assets are $488,375. Let's see how much our liabilities are. Accounts payable. And if you recall, we went ahead and calculated that while we were doing it when we were talking about our materials purchases and how we pay for them. So if I scroll back up to that cash disbursements, there's that accounts payable balance that we already calculated. As far as the taxes goes, we just found that from our income statement. The notes payable and the interest payable, if you recall, we calculated those back when we were dealing with the cash budget to try and determine what our interest expense would be. So there's the $8,000 and there's the $160 for interest. So I'll go ahead and just reference those back for me. And I can add all of those and I get my current liabilities. And remember, current means these are going to have to be paid with cash within a year. The other payables, they were listed on our existing balance sheet at $130,000, and I haven't changed them. We didn't do anything with them, so they're still $130,000. You can think of it like a long-term bond that's still due. And you can add those two together to get your total liabilities. The only thing left is the equity section. The first two accounts, common stock and paid-in capital in excess of par, they are still what was on the existing balance sheet. We didn't do a budget where this company issued more shares of stock or had other changes in equity for simplicity, but we could have done that. We just didn't. So I'll just put those two values on there, 50 and 10, leaving me only with retained earnings. Now, you can see on the completed budget, it's $238,890. But when I look at what's on the data sheet, it says that retained earnings is $238,175. They're not the same, and rightfully so. The retained earnings represents profits that the company has earned but not have distributed as dividends. And I know we pay dividends because we said that we did so down here in January, paid dividends to stockholders. 10 grand. So let's take this 238,175 and start with it. We're going to subtract those dividends and we're going to add to it what profits we had, which they weren't much, $10,715, but hey, it was enough. And that's where you get the $238,891. Now, notice this time when I did that through, your handout should have like $1 there, and that's purely because I've got a rounding issue going on here. When I add all those together, you get your total equity, and when you add that to your liabilities, you get your total liabilities and equity, which does equal your total assets. Now, we've done quite a bit with this master budget, and remember, this is just a specific example, and a lot of companies are far much more in greater detail than this. So hopefully you can get an appreciation of all of the complexities and demands that are involved in creating this. This master budget will also form the basis of your second project. You are going to have your own unique company and you will create a master budget just like we've done here. Very similar in approach, but your facts, your figures, your data is going to be different. So use what we've done in class as a guide. Now, at any time, if you have a question, you can go back and revisit these videos, or as hopefully you've been going through it, pausing it to make sure that you've got your notes. Anytime you have questions, please make sure you do ask me for help.